NVIDIA Corp is currently trading at $183.20 USD, marking an intraday climb of $2.21 or about 1.22% as the market processes the latest shifts in the semiconductor landscape. While a 1% move might seem like standard noise for a high-beta tech giant, what is happening under the surface today is far more significant than a simple green candle on a chart. Most investors are looking at this price action and seeing a stop that is merely recovering from a recent pullback, but the reality is that the floor for this valuation is being rebuilt by a massive wave of capital rotation that few saw coming. There is a gap between the expectation that NVIDIA stock has peaked and the reality of its current cash generation. Most people look at the ticker and think about a bubble that has reached its limit, yet if you look at the fundamental shift in how large-scale data centers are being funded, you see a completely different picture. While the retail crowd is busy wondering if they should use their individual brokerage to take profits, institutional players are treating these 183 levels as a strategic entry point for the next fiscal year. This contrast is the defining tension of the current market. If you were using a platform like Interactive Brokers or checking your positions on the Robinhood app, you might have noticed that the volatility in semiconductors has reached a fever pitch. The narrative lately has been dominated by fears of Blackwell chip delays and thermal issues in server racks, which led many to believe that the growth story was hitting a wall. However, the unexpected development today involves the green light for H200 chip shipments into China. This is a move that many analysts thought was off the table due to regulatory hurdles, but the fact that these shipments are reportedly scheduled for mid-February has created a massive curiosity loop for those who had written off that revenue stream entirely. A common belief right now is that the high growth phase for NVIDIA stock is over and that competitors like AMD are finally catching up. People look at the rise of in-house silicon from companies like Google and Amazon and assume that the demand for third-party GPUs will crater. But the contrarian view, and the one that is being reflected in today's price action, is that NVIDIA is no longer just a hardware provider. They are becoming the operating system for the entire intelligence sector. By acquiring firms like SkedMD to control the Slurm workload manager, they are making it so that even if a data center uses a mix of chips, the software that runs the entire facility is still an NVIDIA product. This creates a level of stickiness that a simple hardware comparison fails to capture. When you look at the daily swings we are seeing right now, it is clear that institutional activity is favoring the heavyweights again. After a brief period where smaller cap tech tried to steal the spotlight, the massive buy orders flowing through Fidelity Wealth Management and Schwab Intelligent Portfolios suggest that the big funds are coming back home to the leaders. The trading volume today is supporting this upward move, showing that this isn't just a low-volume drift, but a concentrated effort to push the stock back toward its previous highs. This momentum is partly fueled by the recent PCE inflation data, which came in cool enough to suggest the Fed might continue to lower rates, making the cost of capital for massive AI infrastructure projects much more manageable. Think about the way you manage your own portfolio. Whether you are focused on online investing through a SoFi trading platform or managing a more traditional set of Fidelity mutual funds, you are likely feeling the pressure of this sector's dominance. It is hard to find an online investment strategy that doesn't have a significant weight in these chips, and for good reason. The sector momentum is currently being driven by a reality where the top 5 cloud providers have committed to spending over $200 billion in capital expenditures in the coming year. A huge portion of that is going directly to one company. It is important to understand the business model that got us here before we look too far ahead. This wasn't an overnight success. For decades, the company was known for gaming. They built the best graphics cards for people who wanted to play high-resolution video games, and that provided a steady stream of revenue that allowed them to experiment with parallel processing. That experimentation led to CUDA, the software platform that essentially forced every developer in the world to learn how to write code for NVIDIA hardware. This is the moat that most people forget about. You can build a faster chip, but if the developers don't know how to use it, the hardware is useless. Past performance has been nothing short of staggering, with the stock moving from what would have been split-adjusted pennies to nearly $100 a share. But looking at older reports doesn't tell the full story of why the stock is sitting at $183 today. It's about the earnings reactions. Every single time the market expects a slowdown, the company reports a 60 or 70% growth rate in their data center business. That is the expectation versus reality in its purest form. Analysts set a high bar, and the company doesn't just clear it, they move the bar higher for the next quarter. For those of you managing your own self-investing through a Fidelity brokerage or an individual brokerage, I want to hear your perspective on the ground. Comment below how many shares of NVIDIA stock you currently hold and what your average cost basis is. It's always interesting to see where the community is positioned during these periods of consolidation. Looking into the next few months, there are several scenarios that could play out. The primary catalyst is the full-scale production of the Blackwell architecture. If the company can prove that the thermal issues are resolved and that they can ship in volume by the end of the first quarter, the $183 price point will look like a bargain in hindsight. There is also the opportunity in the automotive space. While we talk about chatbots and image generation, the real long-term revenue might come from the NVIDIA Drive platform as autonomous vehicles become more common. This is a sector where they are already partnering with major manufacturers, and it provides a diversified hedge against any potential slowdown in the cloud computing market. However, the risks are real. Macroeconomic pressures such as a sudden spike in inflation or a geopolitical shift that affects the supply chain in Taiwan could easily send the stock back to the $150 range. There is also the threat of regulatory overreach. If the government decides that the dominance of one company in the AI space is a problem, we could see antitrust actions that would stifle the ability to bundle software and hardware. This is something that every person involved in online investing needs to watch closely. When you compare NVIDIA stock to something like Apple stock or Tesla stock, you see a different kind of volatility. Apple is a consumer staples company in disguise, with a massive buyback program that keeps a floor under the price. Tesla is a bet on the future of energy and transport, but NVIDIA is a bet on the very foundation of modern computing. If you believe that the world will require more compute power every single year for the next decade, it is hard to bet against the company that provides the most efficient way to get that power. We are seeing a lot of interest in intelligent portfolios and robo-advisors lately, and many of these automated systems are rebalancing into tech as the year winds down. This creates a natural buying pressure that can sustain a rally even when the news cycle is quiet. If you are using investing sites to research your next move, pay attention to the institutional ownership levels. When you see big houses like Fidelity Investments or the various Fidelity IRAs maintaining their positions despite the noise, it tells you that the long-term conviction hasn't wavered. To wrap this up, the central insight here is that the market is currently mispricing the transition from hardware sales to software ecosystem dominance. The expectation is that margins will eventually contract as competition increases, but the reality is that the company is building a wall of software around its hardware that makes it nearly impossible for customers to leave. We started with a live price of $183.20, up over 1%, and that movement is a reflection of a market that is slowly realizing its previous fears might have been overblown. The contrast between what investors believe and what the data shows remains the most important factor for the stock's future. If you are looking for investment help or trying to navigate these waters on your own, remember that the loudest voices in the room are often the ones focused on the short term. The long-term story is written in the tens of billions of dollars being poured into data centers every single quarter. Whether you use the SoFi active investing platform or stick to more traditional Fidelity trading platform options, the key is to understand the difference between a temporary delay and a permanent change in the business. This analysis suggests that while the stock has had a historic run, the valuation today is actually more grounded than it was 6 months ago, when the PE ratio was in the triple digits.
With the current ratio sitting in the mid-40s, we are seeing a company that is growing into its valuation at a record pace. The reality is that the demand for intelligence is not a fad, it is the new baseline for the global economy. As we look toward the 2026 fiscal year, the path for NVIDIA stock will likely be defined by its ability to maintain its lead in the software stack, while successfully launching its most ambitious hardware project to date. Keep an eye on the volume and the institutional flow in your individual brokerage accounts. The way the big capital moves will tell you everything you need to know about the next leg of this story. For now, the bulls are in control, and the 1.22% move today is just another brick in the wall of this ongoing market cycle. It's a professional environment, and the stakes are high, but for those who look deeper than the surface headlines, the opportunities are still